Thank you, Hemant sir. Hi, I am Siddharth Mandalaywala and I will be discussing our investment philosophy which has been evolved over last 11 years. We have done many mistakes and have come across different business cycles which has helped us in coming to this investment philosophy. So basically, we rely on four components in our investment philosophy. First one being external opportunity, second business, third management, and fourth finally, which is valuation. I will take you through all these components in detail. So first is external opportunity. Why external opportunity is important? It is important because the size of the industry should be huge so that the company can become big. You take example of our Nifty companies. Most of the companies are big today in size because their market potential is huge. For example, Infosys in IT sector, TCS in IT sector, Hindustan Unilever in FMCG, HDFC Bank in banking sector, HDFC in non-banking finance. So you can see over here that each company has become big because of the size of the opportunity. So we will always invest in companies where the size of the pond is big and so the fish can become big. Then comes second thing, which is business. This is one of the most important criteria in our stock selection. So in business selection, we go for great businesses. So what is the definition of great? Two components are very important when it comes to great business. First one being return on capital employed. We have taken a very important thing here is the return on capital employed should be greater than 15%. We don't compromise here. Why? Because in India, cost of capital is around 11-12%. So a company should be earning above this level and 15% is that criteria. So if you see ROCE minus cost of capital, it gives you free cash flow. We want company which generates free cash flow. So this is a very important thing for us. After this, we look at earnings growth. Earning growth is equally important. So if there is a ship and a ship wants to move, it needs two things. One is the wings and the other is wind. So wings being return on capital employed and wind being earnings growth. If these two criteria are there, then the ship will move. Now in earnings growth, there is again bad growth and good growth. So I will give you two examples over here. One is a company called United Spirit. In recent con call, they said that they are not able to get their sales above the industry growth. So the growth of industry is, for example, 10%, they are growing at 8 or 9%. But in the same breath, they are saying that they are not chasing growth. They are not going for growth where there is a doubt of receivables. So this is a very important thing which the management is saying, and this is nothing but good growth. So we would go for companies which go for good growth. Now coming to bad growth. Again, I will give you an example here of Yes Bank. We all know Yes Bank was growing like anything. It was growing above industry credit growth. But finally, we all saw what happened. So what was the issue? They were growing, but they were growing in a bad way. They were giving their money to people or corporates where the chances of recovery was less. And this is what happened with Yes Bank. So in August 2018, Yes Bank share price was 400 and today it is hovering around 20 to 25 rupees. So we will always go for companies which is doing good growth, and for that we will see this type of things in it. After this, Other some aspects which I wanted to discuss with you regarding this business is we want companies which do not require capital to grow. We like asset light models. So we will not go for companies or businesses which needs heavy capital, which are capital guzzlers. We would rather go for asset light models, and we have seen in the past that wealth creation has been done more in this type of companies. We also like this type of companies because these companies throw free cash flows. Second, we also like companies which grow through organic acquisition, organic growth, and not through inorganic growth. So we don't prefer companies where the growth happens because of acquisitions. Because generally we have seen that 80% of the acquisitions fail. And so we also don't prefer this type of companies. Third thing is we don't like companies which frequently dilutes their equity. So we would go for companies which has not diluted their equity. The best example in front of us is Infosys. They have never diluted their equity. They have never come with a right issue. They don't want money. They are growing with their internal accruals. So this is the type of company which we want to have in our portfolio. And finally, we will go with debt-free companies, cash-rich companies. We like companies where they don't need debt to grow. And in times like these of COVID-19, we all are watching that this type of companies are having a tough time where they have to service their debt even though their revenues are zero. So we will focus on companies where they are cash rich and they are debt free. Now we come to third aspect, that is management. So in management we look for three things. First, energy. Second, competence. And third, ethics. Ethics is the most important thing. Integrity is the most important thing, because 100 multiplied by 0 is nothing but 0. So if the company is competent, if they have energy, but if they are not good at corporate governance, we would simply avoid this type of companies. We also like companies where management is more focused on good capital allocation and capital distribution. So where they are investing their money. I would give some examples over here. First, the example of Unitech. Unitech was a real estate company, but it ventured into telecom, completely unrelated area, and finally it got dissolved. In the positive side, I will cite you an example of Titan. Titan was a watch company, then it ventured into jewelry company, then now they have ventured into eyewear, saris. So all are related businesses, all are connected with lifestyle businesses. So this is the type of companies which we want to go for. We want clean accounting companies. This is a very important criteria. And finally, when it comes to related party transactions, we need a clear company where there are very few related party transactions or no related party transactions. So this is a very important thing which we look at while assessing a management. And finally, now it boils down to valuation. See, valuing a company is more of an art and less of science. So giving what multiple to a company is very difficult. So generally we avoid companies where the PE multiples become euphoric. Again, I will give you example. In year 2000, Infosys was trading at around 350 PE multiple. So this was completely euphoric. And this type of scenario, if it arises, then we would clearly sell the company, even though external opportunity is good, business is good, management is good. But if the price is not suitable to us, we will not buy. Or if we have that company in our portfolio, we would simply sell it off. But PE is not the right metrics to look at when it comes to short term, because PE will give you just 1 year or 2 year of glimpse in that company, and companies are not here for 1 or 2 years, they are here for 10, 15, 20 years. So this is again a very important metric to look at. Some other things where why companies get higher valuation. For example, Titan currently is trading at around 45 P multiple. So why Titan is getting this type of multiple? It is because they have optionality in their business. They can switch over to one or the other business. They are very consistent with their earnings. They are predictable. For example, HDFC Bank, we all know that they have consistently delivered 25% growth, and of late they have started consistently delivering 20% growth. Third is resilience. Across bad cycles, how they have done. This is also an important factor in which valuations are decided. Fourth is management, depth and transition. How is the management? Is it a one-man army or board-driven company? Again, example of Titan, where Bhaskar Bhatt, their MD, retired last year, and there has been no such visible big change in the company. So it is a board-driven company. And finally, the company should be continuously gaining market share as well as profit share. These all criteria help in giving valuation to a company. So these are the 4 parameters which I wanted to discuss with you in our investment process. Now, how we manage our model portfolios. For the last 11 years, I have been managing 2 plans, that is Concept Legend, which is large cap equity, and Concept Marvel, which is a mid cap equity. So in both the portfolios, we manage around 20 to 22 stocks. It is diversified across 8 to 10 sectors. We don't go over 10% in any of the script while giving weightage, and we don't go over 40% in any sector. So this is to mitigate the risk. We want a diversified portfolio. And finally, we have a very low churning ratio. Our holding period, average holding period is almost 5 years. So we hold a company for average 5 years. And finally, now I want to highlight some productivity analysis of our company, of our research team. So in last 3.5 years, what we have done, our team, which consists of qualified chartered accountants, CFAs, MBAs, we are a total team of 8 people. Here we have 3 research interns, 4 research analysts, 1 head of research, and myself, 1 fund manager. In last 3.5 years, we had attended almost 2,380 conference calls. We have read around 1299 annual reports. Whenever we take any company for research, we dig down and go for last 5 or 7 years annual report. We had done stock specific research of around 252 companies, IPOs of around 73 companies which came in last 3.5 years. We covered almost 39 industries which are across sectors, and finally we bought just 9 companies. We added just 9 companies after doing all this analysis. So you can see that the funnel is wide at the top and it is narrow at the bottom. So we do many things, but we reject many things. And finally the best output comes from that funnel, and that is only being added in our portfolio. So this is the glimpse of what we do in our research process, and this is our investment philosophy. Thank you.